Most traders fail because they chase every signal. You're probably nodding, you've been there. The screens flash green and red. Alerts scream buy and sell, and the thrill of potential profit clouds your judgment. Here's the brutal truth. 80% of trades you think are opportunities are traps. Only 20% of setups ever pay. The difference between amateurs and professionals isn't skill, it's patience and selectivity. It's the ability to wait for conditions where the odds are stacked in your favor, instead of gambling on hope. Jesse Livermore, one of the greatest traders of all time, understood this instinctively. He didn't trade every breakout, every minor dip, or every rumor. He waited for a pivotal point, a setup where risk was defined, the tape confirmed the move, and the potential reward justified the exposure. These moments were rare, precise, and fleeting, and they demanded an almost surgical patience. Let me tell you a story. In 1907, during a chart of massive market panic, Livermore noticed a stock holding just above a critical psychological low. Panic gripped the market. Everyone else was selling, driven by fear and speculation, throwing positions into the abyss without analysis. Yet Livermore did not panic. He observed, he waited. He watched the tape for signs of real strength beneath the chaos. When the conditions aligned, he entered the trade with perfect position sizing, neither too aggressive nor timid. Within days, the stock surged 30%. That's the power of waiting for the right setup, the reward of exercising patience when the crowd is blinded by fear. The lesson is simple but often ignored. Trade when the market confirms you, not when you hope it will. Hope is amateur. Confirmation is professional. The subtlety here is profound. Hope is in Mr. Amateurs act on hunches, news, or sentiment. Professionals act only when the market itself signals alignment. They let evidence dictate moves, not impulse. By focusing on just the 20% of high-probability setups, Livermore dramatically reduced losses, avoided emotional trades, and let his winners run. This focus also created a kind of mental clarity that most traders never experience. Imagine sitting on your hands while the market erupts in chaos, watching traders around you panic and capitulate. The temptation to act is immense, yet the professional stays anchored. Those elite setups, what I call the 80% pattern, aren't always obvious. They hide in consolidation, minor pullbacks, and subtle volume shifts. Recognizing them demands disciplined observation. It's not flashy. It's quiet, almost invisible to those who aren't trained to see it. The ability to wait while others flail, to do nothing while the market screams for action, is a skill that separates amateurs from pros in the harshest way possible. Consider this scenario. A stock drifts sideways for days. Volumes low. Market sentiment negative. Most traders think nothing is happening and move on. Livermore, however, watches carefully. A single, small spike in volume, a tiny uptick in closing prices, an absence of selling pressure. These are his signals. This is where patience pays off, where doing nothing becomes a powerful strategy. Waiting isn't passive. It's preparation, positioning, and observation in action. The market rewards those who can suppress the urge to react, who can sit quietly with conviction, ready to move only when the setup is validated. Amateur traders often mistake movement for opportunity. They see price jump or drop and immediately react, as if activity equals profitability. Professionals, by contrast, understand that the market speaks in confirmation, not noise. They identify patterns, watch for pivots, analyze tape behavior, and then act decisively. This approach transforms trading from gambling into calculated decision-making. Livermore's historical records are filled with examples of trades where he did nothing for days, sometimes weeks, until the tape revealed the truth. When most traders would have forced entries or succumbed to panic, he patiently waited, preserving capital and setting the stage for outsized profits. The rule of thumb for any aspiring professional trader is clear. Observe, wait, confirm, and then act. Trading impulsively on every signal is the fastest path to eroded accounts and frustration. True opportunity is rare, and when it appears, it demands full attention, disciplined entry, and precise risk management. Position sizing is part of this calculus. Even when the setup is correct, overexposure can destroy profits. Livermore always measured risk relative to potential reward, ensuring no single trade could significantly harm his capital. Notice the paradox. The more you wait, the more opportunities you see. The less you react impulsively, the higher your win rate becomes. Traders often think that taking every trade is necessary to make profits, but the opposite is true. By patiently waiting for the 20% of trades that truly meet all criteria, professionals enjoy higher returns, lower stress, and the ability to let winners run without constant interference. This is the essence of the 80% pattern: selectivity, confirmation, and disciplined execution. Here's a subtle point most traders overlook. These setups often appear in the quietest moments of the market. Minor pullbacks, tight consolidations, or fleeting patterns can signal opportunity. They demand observation, tape reading, and an understanding of market psychology. You cannot force them. You cannot wish them into existence. They exist independent of desire, waiting for the trained eye to recognize them. Acting too early or too late turns them into losses. Acting with patience and discipline converts them into substantial profits. Tomorrow's professional trader asks, when do I move and when do I wait? This is not a trivial question. It is the line between consistent profit and chronic failure. Amateurs answer. Emotionally, they chase. They react. They hope. Professionals answer analytically. They wait for pivotal points, tape confirmation, and proper position sizing. They embrace uncertainty, knowing that clarity emerges only when the market itself provides it. The journey begins with patience. Observing, understanding, and waiting for the right moments creates a foundation upon which all professional trading rests. Livermore's edge was never in guesswork. It was in the disciplined observation of rare, high-probability setups. By adopting this mindset, traders move from reactive gambling to calculated participation. They develop the ability to act decisively, confident that their setups have been validated by both price behavior and tape confirmation. In essence, the first step is mastering inaction. Doing nothing is uncomfortable, but in the uncomfortable lies opportunity. As the market flails around you, your patience becomes a weapon. Every tick is a lesson. Every moment of restraint preserves capital. Every correctly observed setup strengthens your professional identity. This is the invisible architecture of the 80% pattern. Rare setups, disciplined observation, patience under pressure, and selective execution. By the time the next chapter arrives, you will understand that recognizing the 80% pattern requires more than rules. It requires a methodology. Livermore's method, precise and repeatable, converts observation into opportunity. It separates the fleeting profit seekers from those who consistently capture market moves. And yet, it begins with one deceptively simple principle: wait, observe, confirm, and then act decisively. Tomorrow, we will dissect the exact three-step method Livermore used to identify these setups, revealing why most traders fail and how professionals consistently seize the 20% that truly matter. Until then, remember, the market rewards patience, not impulsiveness. It rewards observation, not noise. And above all, it rewards those willing to wait for the setups that few ever see. Here's the question every amateur struggles with. How do you know when a trade is actually worth taking? Most traders react impulsively. They see a price move, they hear chatter in the forums, they read headlines, and they convince themselves it's a sure thing. The reality is brutal. Most of those trades will fail, and the results are predictable. Jesse Livermore, however, boiled the process down to three critical signals that told him with far greater certainty whether a trade was likely to succeed. Step 1. Price behavior near a pivotal point. Step 2. Tape confirmation from large operators. Step 3. Position size aligned with risk tolerance. Each step might seem simple in theory, but in practice, it demands observation, discipline, and the ability to do nothing when everything around you screams, "Trade now." The first step, pivotal price behavior, is deceptively powerful. Imagine a stock grinding sideways for weeks. The crowd yells breakout, analysts issue glowing reports, forums erupt with bullish sentiment, but most of these supposed breakouts fail. Livermore didn't care about hype. He observed the market for accumulation signals, subtle spikes in volume that revealed smart money quietly building positions, minor advances above prior resistance, or the absence of selling pressure in what appeared to be a crowded trade. The amateur sees noise. The professional sees preparation. Here's a small story to illustrate. 20 Stein, 2023. In the 1920 seconds, Livermore was monitoring a stock that had been drifting within a narrow range for over a month. Everyone assumed it was stuck, yet he noticed a small uptick in closing prices and consistent volume increases on minor rallies. These were not dramatic moves. They were whispers, subtle indications that insiders were quietly accumulating. Most traders ignored it, chasing stronger moves elsewhere. Livermore, however, marked the pivotal point, the precise price level where the accumulation would likely trigger a breakout, and waited. He didn't jump at the first signal. He didn't act on rumors or sentiment. He waited until the tape confirmed what he suspected. This combination of observation and patience allowed him to act decisively when the opportunity was real. It's a skill, not a guess. Step 2. Tape reading adds another layer of precision. Here's a counterintuitive truth. Sometimes the market whispers before it screams. While most traders scan for explosive moves, Livermore read the prints to understand what the big operators were doing. The tape told a story: stealth accumulation, minor withdrawals, stops being tested but not triggered. Every transaction hinted at intent. He could see when positions were quietly being established and when the crowd's behavior was likely to reverse. Amateur traders, by contrast, see only price movement. They react to the action itself, rather than the underlying context. Professionals listen to the tape because it tells the truth before it becomes obvious to the majority. A subtle spike in volume at a resistance level, followed by a lack of selling pressure, might seem insignificant, but combined with the right pivot, it signals potential for a profitable move. Most traders miss this entirely because they want instant validation. They want confirmation in the form of rapid, visible gains. Waiting for the tape's confirmation is uncomfortable, yet it is the only way to increase probability while minimizing risk. Step 3 is position size. Even when steps 1 and 2 align perfectly, Livermore never committed full capital at the first sign of strength. Instead, he pyramided his position. The first trade was small, enough to participate without overexposing. Then, as the tape confirmed and the price behavior validated the setup, he gradually increased exposure. Amateur traders do the opposite. They overcommit early, panic at minor retracements, and magnify losses instead of profits. Pyramiding isn't simply adding to winners. It's about respecting risk limits while allowing your capital to grow in proportion to market confirmation. This approach reinforces a professional mindset. Let the market tell you the truth before you put your money where your mouth is. The maxim isn't poetic fluff. It's a rule that has preserved fortunes for over a century. To visualize this, consider a modern example. A stock trades in a tight range, slightly above support. Volume is moderate, but insiders or institutional players are subtly accumulating. The amateur sees nothing, gets frustrated by stagnation, and looks elsewhere. The professional notes the pivotal point, monitors the tape for subtle accumulation, and plans a small entry. When confirmation appears either through a spike in volume or a slight breach of resistance, the position is increased carefully. Notice the discipline required. Every step is informed, calculated, and measured. The professional doesn't care about missing 80% of trades. They know the ones they do take matter exponentially more. This three-step method, pivotal point, tape confirmation, and position sizing, also acts as a psychological filter. It forces the trader to pause, observe, and question every assumption. Amateurs often skip steps, allowing hope and impulse to dictate action. Professionals adhere to the process, even when boredom, frustration, or fear makes inaction uncomfortable. In practice, this means that for days, a professional might do nothing while the market meanders. The temptation to act is immense. Most traders cannot resist. That's why only a small percentage of traders consistently profit. They respect the waiting period, they honor the signals, and they obey the discipline of calculated entry. Here's another story to illustrate patience in action. In the late 1910 seconds, Livermore tracked a stock that had been consolidating for weeks. All signs of accumulation were present, yet the tape remained quiet at times. He did not force a trade. He observed fluctuations, minor volume surges, and tested stops. When confirmation finally appeared, a steady uptick on the tape paired with higher than usual closing prices, he scaled into the position. Within days, the stock moved decisively, generating returns that far exceeded what could have been achieved by impulsive trading. The lesson is clear. Waiting and confirming dramatically increases the probability of success. Impatience is a silent killer. The 3 steps also serve as a framework for evaluating risk. Step 1 identifies the precise price where the setup becomes favorable. Step 2 ensures that the underlying market behavior supports the move. And Step 3 determines how much to risk based on conviction and confirmation. By combining these 3 elements, the professional creates a self-reinforcing process. Observation leads to validation. Validation guides sizing, and sizing protects capital while allowing for growth. Every trade taken under this framework is purposeful, deliberate, and rational. Amateurs often overlook the subtleties. They see price move and assume opportunity. They act without understanding whether the tape or underlying accumulation supports the trade. They misjudge position size, either overcommitting or underexposing. Professionals, however, calibrate their actions to probability, risk, and confirmation. This is why even experienced traders fail. They neglect one or more of these steps, replacing methodology with hope. The market punishes hope relentlessly. To embed this in your own trading, start by observing price behavior near pivotal points without trading. Track volume changes, closing prices relative to prior highs and lows, and the presence of stops being tested. Watch the tape quietly, noting subtle accumulation and withdrawals. Only then, when signals align, plan position sizing with strict adherence to risk limits. The more you practice this methodology, the more intuitive it becomes. Soon, patterns that seemed invisible will stand out clearly, and hesitation will give way to confident execution. Discipline, in these 3 steps, also builds mental resilience. Waiting for confirmation tempers fear and greed, while pyramiding positions enforces patience in action. Traders begin to appreciate that not every movement is an opportunity, and not every setup requires engagement. This is critical because emotional reactions to market noise are the #1 cause of losses. Professionals learn to detach emotionally while remaining analytically engaged, a paradox that separates them from the crowd. Ultimately, the 3-step method is more than a system. It is a mindset. It trains traders to observe, confirm, and act with precision. It forces the discipline to ignore the noise, to respect the tape, and to scale exposure according to evidence. The market becomes a teacher, not a threat. Every observation provides data. Every patient pause protects capital. Every measured entry increases the probability of a successful outcome. By mastering this, traders transition from reactive participants to strategic operators. The seed for the next chapter is emotional discipline. Recognizing setups is one thing. Executing them without succumbing to fear or greed is another. Most traders fail at this juncture. They see confirmation, scale their positions, and then panic at minor retracements or let greed drive overcommitment. Chapter 3 will explore why fear and greed destroy setups and how to master the psychology of waiting. Until then, internalize these 3 steps. Thanks for watching, and subscribe. Until then, thanks for watching. Pivotal point identification, tape confirmation, and disciplined position sizing are not optional. They are the foundation of the 80% pattern. Ignore them, and the market will punish you. Respect them, and the rare high-probability setups become your domain. By consistently applying these 3 steps, traders gain a professional identity. Amateurs chase trades. Professionals wait. Amateurs act on hope. Professionals act on confirmation. Amateurs risk recklessly. Professionals calculate. This identity shift is subtle, but transformative. Over time, the repeated application of the 3-step process builds confidence, reduces stress, and increases average trade quality. Traders learn that missing trades is not failure. Selectivity is profit. The 80% pattern is about precision, and precision requires discipline. Observe carefully. Wait for tape confirmation. Scale positions appropriately. These are not just rules, they are principles that define professional trading. They create a framework for decision-making that minimizes emotion, maximizes probability, and transforms trading into a repeatable process. Amateurs ignore these lessons and pay the price. Professionals internalize them and reap the rewards. Tomorrow, in Chapter 3, we will explore the emotional dimension. Fear and greed are silent killers that can undo even perfectly executed trades. Recognizing setups is crucial, but mastering the psychology of waiting is where professionals truly separate themselves from amateurs. The 3-step method gives you the foundation, but emotional discipline is the scaffolding that supports it. Without it, even the best setups collapse under the weight of human impulses. By mastering price behavior, tape confirmation, and position sizing, you are halfway to understanding why only 20% of setups produce the majority of profits. The next step is learning how to act consistently without being hijacked by emotion. This is where the professional mindset solidifies. Waiting for confirmation, scaling with discipline, and navigating fear and greed with calm authority. Livermore's genius was not in knowing the market would move, it was in knowing when to act and when to wait. These are lessons that every aspiring trader must learn to internalize. The 80% pattern is not about constant action. It is about selective, deliberate, disciplined participation. The amateur jumps at noise. The professional waits for signals. The amateur overcommits. The professional pyramids. The amateur panics. The professional confirms. Recognizing this distinction and embedding it into your behavior is the gateway to consistent profitability. By the end of this chapter, you should understand that spotting setups is only one part of the journey. Acting upon them with discipline, confidence, and clarity is the other. And mastering both is what separates the rare professionals from the majority who lose. Every trader believes they are disciplined until the market tests them. It is one of the harshest lessons in trading. The moment charts start moving against your expectations, or when the tape teases a breakout, the so-called discipline is exposed. Fear and greed are silent killers of the 80% pattern. Jesse Livermore knew this better than anyone. He once said, "The human side of every person will always defeat the mechanical side if unchecked." Think about that. No system, no method, no set of rules can substitute for the mental control needed to execute them correctly. You can have the perfect setup in front of you, but if fear or greed takes over, your edge evaporates. Every trade carries risk, not just the financial kind, but the emotional kind. Recognizing and mastering this is what separates the professional from the amateur. Consider a simple scenario. 2 traders spot the same setup. One, driven by greed, jumps in early, convinced the move is imminent. The other waits patiently, watching for confirmation from the tape and market behavior. Within hours, the first trader sees the price fluctuate slightly, panics, and exits for a small loss. Meanwhile, the patient trader, guided by observation and discipline, sees the breakout confirm itself and captures the full move. The lesson is stark. Fear makes you exit too soon. Greed makes you enter too soon, and both destroy your edge. The market does not reward impulse. It rewards preparation, patience, and precise timing. This is where the professional leverages what I call the patience premium, the willingness to do nothing when everything around you screams, "Trade now." In real time, the market feels urgent. Red and green numbers flash on the screen. Price gaps occur. News headlines explode. And social media churns with speculation. The temptation to act is immense. Yet the paradox is clear. Sometimes doing nothing is the most profitable trade. Livermore illustrated this repeatedly. On one occasion, he watched a stock flirt with a resistance level for 3 consecutive days. The market seemed ready to move. Everyone else was trading wildly, chasing every tick. He refused to act. He didn't buy at the first sign of a breakout, nor did he sell when the tape dipped temporarily. He waited. He observed. And when the tape finally confirmed a decisive move, he entered confidently, and the position multiplied threefold. That's the power of patience. The ability to sit quietly, even in the face of apparent opportunity, is what transforms potential into actualized profit. Patience is not an abstract concept. It is a skill that can be cultivated. Start with defining your risk clearly. Know exactly how much you are willing to lose on any single trade before you ever touch your platform. Then, write your criteria for entry, confirmation, and position size in advance. This pre-written plan acts as a mental guide, removing emotional guesswork from the equation. Finally, treat the market as a teacher, not an adversary. Every tick, every fluctuation, every subtle shift in volume provides feedback. Observing without reacting turns the market into a learning tool rather than a source of panic. A simple maxim captures the essence of this principle. Discipline is the bridge between setups and profits. Even the best 80% pattern, the most textbook pivot, the perfect accumulation, and ideal tape confirmation is wasted without discipline. Patience ensures that trades are taken only when probability is high and risk is controlled. It allows the professional to let winners run while avoiding the emotional traps that destroy amateurs. The patience premium, in other words, converts waiting into leverage, transforming restraint into measurable financial advantage. Let's dig deeper into the psychology behind this. Amateurs fear missing out. They see momentum building elsewhere and feel pressure to act. They see others posting profits and think opportunity is slipping away. This fear drives impulsive entries, which often end in small losses or catastrophic mistakes. Professionals, however, understand that the market will continue to produce setups. They realize that waiting for confirmation does not mean missing opportunity, it means enhancing probability. The market is not a single event, it is a constant flow of information. Those who wait for clarity do not miss the market. They align themselves with it. Greed is equally destructive. When traders act on the expectation of a large move without confirmation, they expose themselves to unnecessary risk. Early entries feel profitable in the imagination but are often punished in reality. Livermore recognized that every trade is a test of human emotion. By controlling greed, he avoided overexposure. By controlling fear, he avoided premature exits. The combination of these emotional controls creates the patience premium, a measurable advantage derived from waiting, observing, and acting decisively only when conditions align. A practical example illustrates this clearly. Suppose a stock has been consolidating near a pivotal resistance level. Volume is slightly higher than average, but there is no dramatic price action. The amateur trader might see this as a breakout opportunity and enter immediately, risking a full position. Any retracement triggers panic, and the trade may be closed at a loss. The professional, however, monitors the tape, noting subtle accumulation patterns and how the market responds to small price tests. When confirmation arrives, a steady increase in buying pressure, the absence of selling, or a minor breach of resistance, the professional enters gradually, scaling with conviction. This approach avoids emotional interference and maximizes probability. Patience has transformed observation into opportunity. Discipline and patience also reinforce one another. Waiting for confirmation instills confidence, which reduces the psychological pressure to act hastily. Predefining risk and criteria creates a structure that supports calm decision-making. Treating the market as a teacher allows the trader to learn from mistakes without emotional contamination. Together, these elements form a cohesive strategy that protects capital and enhances returns. Amateurs, by contrast, operate without structure, subject to impulses, and therefore suffer predictable losses. It is also important to note that patience is not inaction for its own sake. It is active observation. Every tick is data. Every minor fluctuation in volume or price contains information. Professionals analyze these signals continuously, adjusting their plans, watching for subtle cues, and mentally preparing for precise execution. In other words, doing nothing in terms of trade execution is rarely passive. It is preparation, positioning, and strategic decision-making in action. This distinction is critical. Amateurs equate waiting with inactivity. Professionals understand it as a prelude to decisive action. The patience premium also shapes long-term performance. Traders who master waiting experience lower stress, higher confidence, and more consistent results. By letting high-probability setups develop fully, they reduce unnecessary losses and improve the quality of their trades. Over time, this produces compounding advantages: better decision-making, preserved capital, and a higher success rate. This psychological edge is as important as any technical skill, because it is what allows traders to execute the 80% pattern reliably. Consider a historical anecdote. Livermore observed a stock hovering just below a key resistance. Everyone was trading aggressively around it. He did nothing. The tape remained quiet. The price oscillated slightly, and no dramatic news occurred. Many traders grew impatient and entered early. Livermore waited, letting the market validate itself. When confirmation came, he entered with precision, scaling his position to the point where profits were maximized and risk was minimized. The lesson is unmistakable. Emotional control allows for capitalizing on setups that would otherwise be lost to panic or greed. The three protocols for building patience: defining risk, pre-writing criteria, and treating the market as a teacher, are deceptively simple. Yet, they are difficult to implement consistently because human instincts constantly push for immediate action. Fear tells you to exit too early. Greed tells you to enter too soon. By adhering to these protocols, a trader creates mental scaffolding that supports correct execution. Over time, these behaviors become internalized, and patience becomes a natural part of the trading process. The maxim discipline is the bridge between setups and profits, encapsulates the essence of the patience premium. Without discipline, even the most statistically favorable pattern fails. Every high probability setup requires not just identification, but precise, patient execution. Fear and greed are not external market forces. They are internal reactions that, if left unchecked, erase any edge. Mastering them transforms the theoretical 80% pattern into actual, repeatable results. The seed for the next chapter is clear. Understanding when to wait is only half the battle. Knowing when to cut losses fast is the other half. Most traders fail here, turning profitable setups into disasters by letting small losses compound or by holding winners too tightly. Chapter 4 will reveal Livermore's secret rules for exits, the strategies he used to protect profits and control risk, and why many traders turn winners into losers. Until then, internalize the patience premium. Recognize that waiting is not a passive act. It is a professional skill. It is the bridge between setup and profit, between observation and execution, between potential and realized gain. By consistently applying the principles of patience, traders begin to shift their identity. Amateurs chase, react, and hope. Professionals wait, confirm, and execute. Amateurs act impulsively, guided by fear and greed. Professionals act strategically, guided by evidence and discipline. Mastering patience is what allows the 80% pattern to consistently produce profits, turning rare, high-probability setups into reliable sources of gain. Finally, remember this: the market does not reward action, it rewards correct action. Acting without patience is acting without information. Waiting is not weakness, it is preparation. The patience premium ensures that when the market finally gives the signal, the professional trader is ready to execute with precision, scaling appropriately, and capturing the full potential of the 80% pattern. The emotional mastery of waiting sets the stage for disciplined exits, which is where the next chapter begins. Understanding this will ensure that even in volatile markets, your edge is protected and your trading remains consistently profitable. Entry is only half the battle. Exits define the game. Jesse Livermore's genius wasn't just spotting setups, it was knowing exactly when to lock in profits and, more importantly, when to cut losses fast. Most amateurs hold losers, hoping they will turn around. They convince themselves that if they just wait a little longer, the market will reverse, and they will recoup their losses. That is precisely the opposite of professional behavior. Livermore's rule was simple, brutal, and timeless. The big money is made by cutting losses quickly. He didn't see stops as guarantees. They were not magic shields, but as tools to protect capital, to enforce discipline, and to keep losses small enough that even a losing trade would not derail the overall account. The moment a trade violates the parameters he had defined in advance, he would exit. This disciplined approach ensured longevity and allowed him to live to fight another day, unlike the amateur, who often erodes their capital chasing hope. Position sizing is intimately tied to exits. Even when using stops, Livermore calculated his exposure precisely, so that any single loss could never threaten the account. Professionals understand that risk is not just about the trade itself, but about the relationship of that trade to total capital. A $10,000 loss might feel large in isolation, but if it represents only 1–2% of your account, it is tolerable and survivable. The amateur, in contrast, often goes all in, or sizes without a clear risk plan, magnifying the psychological and financial impact of a loss. By combining defined stops with precise position sizing, the professional creates a margin of safety that protects both money and mind, allowing for clearer judgment and the patience to wait for confirmation of winning trades. Pyramiding is the other side of disciplined exits. Once confirmation arrives and the initial position proves itself, a professional adds incrementally to the trade, but always in alignment with risk tolerance. Livermore didn't pile in blindly. He added cautiously, letting winners run while containing downside exposure. The amateur, by contrast, often overcommits immediately, compounding risk and magnifying losses if the market turns. A historical example illustrates this perfectly. Livermore once entered a stock with $10,000 at risk after identifying a confirmed setup. Over the next week, as the tape validated his thesis, he pyramided twice, gradually increasing exposure but never exceeding $30,000. The stock subsequently advanced 25%. The amateur, who might have committed $50,000 at the first sign of strength, would have panicked at minor volatility, exiting early and turning potential gains into frustration or loss. Exits are not just about protecting against losses, they are about maximizing winners. Professionals understand that letting profits run is equally as important as stopping losses quickly. Livermore often allowed winning positions to expand well beyond initial expectations, trusting the market to continue validating his entry. Discipline, patience, and a structured approach to scaling create the conditions for compounding gains. The maxim to internalize is simple but profound. Cut losses fast. Let winners run. Respect your risk. Without disciplined exits, even the most favorable 80% pattern is meaningless. You might identify the perfect setup, enter at the right time, but without proper exit strategy, your edge is quickly erased. Exits also serve as a psychological anchor. stabilizing emotions in volatile markets. Traders who fear losses are prone to overreact, holding on to losing positions in denial. Those who fail to plan for scaling into winners often take profits too early, driven by greed and anxiety. Professionals counter this with predetermined exits, pyramiding protocols, and strict adherence to risk limits. The process is mathematical, objective, and repeatable, leaving little room for emotional decision-making. It's worth noting that every trade has its life cycle. Entry, confirmation, scaling, and exit are interconnected. The professional evaluates the trade continuously, using tape, price action, and volume as feedback mechanisms. If the setup continues to validate, exposure can grow within predetermined limits. If the trade falters, exits are executed immediately. This dynamic management is part of what transforms the 80% pattern from theory into realized profits. It ensures that mistakes are minimized, winners are amplified, and the trading process remains consistent. The discipline of cutting losses quickly cannot be overstated. Amateurs often rationalize, it's just a small retracement, or it'll come back. These rationalizations lead to compounding losses and emotional exhaustion. Professionals understand that no trade is guaranteed. A loss should be acknowledged quickly and contained, not rationalized into larger damage. This discipline protects capital and confidence, which are themselves critical trading assets. Pyramiding, on the other hand, allows the trader to expand exposure intelligently. Professionals incrementally increase size only when evidence supports it. Each addition is supported by confirmation from price behavior and tape. This allows winners to grow while keeping risk controlled. By structuring entries and exits with disciplined scaling, the trader transforms high-probability setups into compoundable profits. It's the exact opposite of haphazard trading, where fear and greed dictate action and every trade is emotionally volatile. Historical examples demonstrate the magnitude of disciplined exits combined with pyramiding. Livermore repeatedly scaled into positions only after confirmation, allowing his capital to grow exponentially. By respecting stops and not overcommitting, he preserved enough flexibility to participate in multiple opportunities simultaneously, creating a portfolio of high-probability trades rather than relying on single, risky bets. Professionals replicate this discipline. Each trade is small relative to capital, scaled according to confirmation, and exited decisively when invalidated. Amateurs, conversely, hold on to losers, double down recklessly, or exit winners prematurely. They confuse noise for opportunity, and impulsiveness erodes both capital and confidence. By contrast, professional exits are unemotional, mathematically grounded, and repeatable. This disciplined approach is the backbone of consistent profitability and the final operational step that converts the 80% pattern into actual trading results. Beyond mechanics, exits also reinforce the professional identity. Following strict stop-loss rules and pyramiding protocols cultivates mental toughness. Traders learn that the market cannot be controlled. Only responses can. Emotional detachment becomes possible through disciplined execution, and the psychological advantage compounds over time. Waiting for confirmation, scaling gradually, and respecting stops all reinforce confidence and reduce anxiety in turbulent markets. Now, there is one more layer to Livermore's strategy, a subtle, often overlooked secret. Beyond entry, scaling, and exits, he applied what could be called an invisible filter, an instinctual sense that sometimes, even when all technical signals align, the market is not ready to move. He would sit on the sidelines, refusing to engage, trusting intuition honed by decades of observation and tape reading. This psychological filter protected him from chasing false setups, preserving capital and mental clarity. Most traders never learn this skill because they are conditioned to act, to fill screens with positions regardless of hidden signals. This invisible filter emphasizes that trading is as much psychological as it is mechanical. Even with perfect pivots, tape confirmation, and disciplined exits. The professional must recognize when not to trade. Restraint is a skill, and applying it systematically separates the consistent winners from the impulsive amateurs. Understanding this completes the loop of the 80% pattern. Entry, observation, confirmation, pyramiding, and disciplined exits are critical, but knowing when to sit out entirely ensures survival and preserves the opportunity for higher probability trades. The maxim is clear: cut losses fast, let winners run, scale with discipline, and respect the market signals, both explicit and subtle. Without this full system, setups are wasted. With it, the professional consistently captures the 20% of trades that generate the majority of profits. The market rewards process over impulsivity, discipline over hope, and observation over reaction. Chapter 5 will uncover Livermore's final principle, the invisible psychological filter that signals when not to trade, even when all apparent conditions align. This subtle, counterintuitive skill completes the architecture of the 80% pattern and is the difference between surviving in the market and thriving consistently. Until then, internalize disciplined exits, understand the mechanics of pyramiding, and respect the protective power of stopping losses quickly. Without mastery of these elements, even the most promising setups collapse under emotion or poor risk management. The final piece of the 80% pattern isn't drawn on a chart, it's etched in your mind. Every trader studies price, volume, tape, and setups. Few study silence. Jesse. Livermore often spent days, weeks, even months, watching markets without taking a single position. The crowd mocked him for doing nothing. Yet that very inaction preserved his capital and sanity. The market, in its infinite rhythm, sometimes whispers no. Professionals listen, amateurs don't. Most traders see inaction as failure. Livermore saw it as protection. The invisible filter, the one that stops you from trading when everything looks right but something feels wrong, is what keeps professionals alive long enough to win. This invisible filter is subtle. The tape can look perfect, the price aligned, the setup textbook. Still, something doesn't fit. Maybe it's the volume too quiet or too erratic. Maybe it's the market tone, a strange divergence between indexes, or a sudden shift in sentiment that doesn't match the move. Professionals sense these fractures. They've learned to feel the texture of the market, not just read its numbers. They step back when the tension, energy doesn't match the pattern. Amateurs, driven by the fear of missing out, ignore the whisper. They enter the trade anyway, and the market punishes them. Livermore understood that trading isn't just about patterns, it's about pulse. He called it the feel of the market, a sense that develops only after thousands of hours of observation. It's intuition refined by discipline, not emotion. When a setup aligned perfectly but his instincts whispered not yet, he waited. That patience often saved him from catastrophic losses. There's a famous story from 1920. Livermore spotted a textbook breakout in a heavily traded stock. Every signal screamed buy, pivotal point confirmed. Volume steady, price structure ideal. But something in the tape lacked conviction. The movement was mechanical, not organic. He stayed out. Hours later, the breakout failed spectacularly, trapping every eager trader who couldn't resist. Livermore avoided the disaster entirely. That's the invisible filter. In action, silent, unquantifiable, but essential. To apply this filter, you must first respect uncertainty. The market owes you nothing, not a trade, not an opportunity, not even a clear signal. Professionals know that the best trades emerge from alignment across multiple factors: technicals, tape, sentiment, and psychology. When even one of those feels off, they stand aside. The amateur sees the same hesitation and feels frustration, thinking, if I don't take this one, I'll miss the move. That thought, fear disguised as urgency, is the enemy of longevity. The professional reframes it: if I don't take this one, I'll protect my capital for the next true setup. One mindset bleeds accounts, the other compounds wealth. The invisible filter is not mystical intuition, it's data disguised as feeling. It's the subconscious mind, trained by thousands of observations, detecting anomalies too subtle for conscious analysis. Professionals respect this feeling. Amateurs dismiss it. When something feels wrong despite perfect conditions, it's often because your pattern recognition senses imbalance and underlying tension in price action, a hidden trap. The professional listens. The amateur challenges it and loses. Livermore developed protocols for this restraint. Step 1. Predefine setups. Know your 80% pattern intimately. Write it down. Define exactly what price behavior, tape confirmation, and volume alignment must occur before entry. Step 2. Respect market signals. If the broader market is unstable, if sentiment feels stretched, or if volatility surges unexpectedly, step back. Even a perfect stock setup can fail when the tide is wrong. Step 3. Sit quietly until confirmation is undeniable. Wait for the market to prove you right. Professionals act only after the market removes doubt. The discipline to do nothing when the world screams action, that's the mark of mastery. This invisible filter also manifests in timing. Professionals understand that being early is the same as being wrong. A great setup taken too soon becomes a loss. The same setup taken at the right moment becomes a winner. Livermore waited for harmony between signal and confirmation. When the tape aligned, he acted without hesitation. Until then, he was content to wait. Amateurs interpret waiting as wasted time. Professionals see it as the cost of accuracy. Think of trading like a battlefield. Every bullet you fire depletes ammunition, your capital. The amateur fires at every movement, hoping to hit something. The professional waits, studies the terrain, and fires only when the shot is certain. The invisible filter is the trigger discipline of trading. It's what prevents overtrading, protects emotional balance, and keeps your capital intact. Every time you skip a marginal trade, you buy yourself another opportunity to strike when conditions are truly aligned. Livermore often said, "There is a time to go long, a time to go short, and a time to go fishing." That last part, a time to go fishing, is what most traders forget. The fishing time isn't inactivity, it's preparation. It's when professionals review setups, assess conditions, and wait for the market to reveal its hand. That patience is not laziness, it's leverage. By not trading during uncertain conditions, professionals preserve clarity and confidence, while amateurs exhaust both. This filter is also a defense against emotional fatigue. Constant engagement with the market erodes objectivity. Amateurs chase every tick, flooding their minds with noise. Professionals embrace stillness. They know that clarity emerges only in quiet observation. This balance between action and inaction creates sustainability, the ability to trade for decades rather than months. Livermore's success came from mastering both sides of trading: aggression when probability was high, and restraint when signals were mixed. His invisible filter allowed him to avoid low-quality trades, and focus energy on the 20% that truly mattered. The irony is that this final piece of the 80% pattern feels the least tangible, yet it's the most powerful. It's the difference between a trader who survives and one who thrives. A modern analogy helps. Imagine a pilot flying through turbulence. The instruments may indicate everything is fine, but the subtle vibration of the aircraft tells a different story. The experienced pilot senses it, adjusts, and waits for smoother air. The novice, ignoring instinct, pushes forward and risks disaster. The invisible filter works the same way. It's the internal warning system built through experience, alerting you to unseen dangers that charts alone can't show. Professionals cultivate this filter by observing without attachment. They watch how markets respond to news, how volume behaves during quiet sessions, how price reacts near pivots. Over time, these observations form an inner compass. The more data you feed it, the sharper it becomes. The key is to trust it not as superstition, but as pattern recognition matured into intuition. Here's the protocol recap for mastering the invisible filter. Predefined setups. Know exactly what qualifies as an 80% pattern. Respect market context. Favor alignment between setups and the broader environment. Trust hesitation. If something feels off, step aside. Wait for undeniable confirmation. Let the market prove your thesis before committing. The maxim to remember: the market will teach you when to act and when to wait. Waiting is not weakness, it is wisdom. The best traders trade less but win more. Each trade becomes a calculated decision, not a hope-driven gamble. The invisible filter turns uncertainty into safety, transforming inaction into protection. As we close the circle of the 80% pattern, remember the architecture we've built. Cut losses fast, size small, wait patiently, let winners run, respect the tape, and above all, listen when the market whispers no. These principles are not isolated, they form a cohesive mindset. Professionals internalize them until they become instinctive. The result is a trading process defined not by excitement but by precision, not by frequency but by consistency. Livermore's legacy isn't a collection of tactics. It's a philosophy of restraint, observation, and control. The 80% pattern teaches that success in markets comes not from endless action but from selective execution. Each trade should feel inevitable, clear, confirmed, and fully aligned. If it doesn't, step back. There's no penalty for patience, only protection. The final takeaway is simple yet profound. Your greatest edge is discernment. Every time you choose not to trade, you strengthen your discipline. Every time you listen to the invisible filter, you reinforce longevity. The market rewards those who respect its rhythm. Livermore's mastery came not from predicting direction, but from aligning action with timing, sentiment, and conviction. And so, the 80% pattern closes where it began, not with more trades, but with better ones. If you've internalized these principles, you've already taken the first step toward professional mastery. Cut losses fast, size small, wait for confirmation, respect your risk. And when all else aligns but your instincts whisper no, listen. That whisper is the invisible filter that separates amateurs from professionals, survivors from casualties, and noise from clarity. If you've absorbed this lesson, the next step is natural. The following discussion will dive deeper into timing the tape itself, how Livermore read the flow of orders, volume, and momentum to execute with surgical precision. That is the next frontier, the subtle art that distinguishes the 1% of consistently profitable traders from the rest.